Good evening, everyone. What I'm going to do is go through a number of different lessons, different points I learned from interviewing some of the world's greatest traders over many years. The 4 Market Wizard books I did were done over a period probably of 25 years. And so we're going to cover, only some, but some of the very key points that I got from talking to these people who were very successful in the markets, and we'll share some of the stories and the points of those stories. So to begin with Michael Marcus. Michael is he was actually the first person, the first interview subject in the first Market Wizard book, and his story is particularly interesting because of his many failures in his starting days. And I won't, there's not enough time to go through all of it, but after he'd gotten interested in markets through a college friend and who told him that he could make lots of money and was going to advise him, and he soon discovered that his friend didn't know anything, but he ended up losing his money, but he got the bug to trade the markets. He then had he came from a relatively poor family. His father had died and left a $3,000 insurance policy, so he cashed that in and he traded that in the markets, and he lost it all, and he just couldn't give up. So he started studying the markets, and he started reading, and he got involved in trying to trade grains, and he was reading all about the fundamentals of grains. And this was back in a year where there was a drought of the corn crop, and he got the idea to go long corn because of this blight. And he had a few $1,000s that he had scraped together, and he turned it into $30,000. So he thought, now I'm successful, now I'm on my way. So there was a theory that this disease, this blight, was going to winter over, meaning it would again affect the next year's crop. So he said, now I'm really going to build a fortune. And he took all his $30,000. Not only that, he borrowed $20,000 from his mother, so he had $50,000. His mother was poor. It was like she didn't have much money, more money in the world than that. And he bought it, put it all into the corn market. And then one morning there was a story in one of the financial papers, and the headline read, "There's more blight on the floor of the exchange than there is in the fields of Iowa." And the market went immediately limit down, and it went down further, and before he knew it, he had lost the entire $30,000, and not only that, he lost $12,000 of his mother's money. Now, Michael went on to become very successful, and I'll leave that for the moment. I'll come back to it, but I'm just trying to give you a sense here of the beginnings of these traders, as good as they were often riddled with multiple failures. Let me give you another story here, which concerns Paul Tudor Jones. Now, Michael Marcus, no one would have known who he was if I didn't write the book. He's a very private person. He was an immensely successful trader eventually, but nobody would have known him because he was trading for a private firm. Paul Tudor Jones is much better known. He eventually went on to form a hedge fund which managed tens of billions. By the time I interviewed him, he had 5 years where he had made about triple-digit returns 5 years in a row. So one of the things that we talked about was his earlier days, and he told me about his most painful trade. And this trade was quite traumatic. He was on the floor. This was when he was trading just cotton. He was on the floor of the exchange, and obviously some of these stories, we go back to the days of the floor. We don't have floors anymore, but they do make for more drama. And he was watching the last month of the old crop, July cotton. So in cotton, there's the last month of an old crop is July, and then you transition to the next year's crop. And there's only certain types of variety of cotton that can be delivered, and that's called deliverable supply. And by the time you get to the end of the year, those could be in short supply or not. So he's watching the market, and it goes to a new low. It goes to a low below any low price it had made. And as soon as it goes to new low and there's lots of selling, and a couple of minutes later, it comes roaring back, and it's now up for the day. So Paul looks at this and he says, aha, this is a bear trap. And many times, and I'll explain a bear trap, and this is actually, bear traps and bull traps are actually very, very useful signals normally. A bear trap is when you have a market, say it's in a trading range, a long trading range, and it goes to a new low and then comes immediately back. And it's called, what happens a lot of times is the market will go and take out all the stops that are right below the old lows, because that's a place where lots of people put their stops. And then once it takes out all those stops and there's no more selling, it has a vacuum on the upside, and the market comes roaring back. So Paul thought, aha, and a lot of times that type of action could be a major bottom. So Paul thought, aha, this is a major bottom, and he went long, but what he did is he put in an order for a very, very large number of contracts, much larger than he should have. And he puts in the order in the cotton pit, and jumping over all the other brokers is another broker saying, so Paul is buying, and the other broker jumps over everybody screaming sold. And the broker that sold him, that was on the other side of that trade, was the broker for the merchant who held the most of the deliverable supply for the cotton. In other words, he knew what the situation was. And Paul's face turned white. He knew he was dead in the water, because the seller knew they had plenty of supply, and everybody in the pit knew that Paul was wrong, and everybody started selling. And Paul, market lock limit down. He barely get out of any positions. It went down limit down for several days in a row. And by the time he got out of that trade, he had lost, and this is after he had made quite a bit of money, he lost approximately 2/3 of his account and the money he was managing. He had lost about 65%. And this was in one trade in a few days. And that one trade so traumatized him that he almost gave up. He almost gave up trading, and he kind of did introspection. And he said, "Why make this a process of pain? Why not make it a pleasurable process?" And that trade taught him risk management, and we will certainly get back to that because that's a very important lesson. Let me give you one more example, and you'll see the connection. There are multiple. I'm giving you some classic. First of all, I'm picking 3 great, very, very great traders, and I'm giving you their early failures, and there are connections between their failures and lessons to be learned, all of which we'll get to. So the third one I'm going to give you is Bruce Kovner. Bruce Kovner is he eventually formed a firm Caxton. Caxton is another firm that managed tens of billions of dollars. He had a career of decades of making excellent returns and with good risk control. When I interviewed him, he was a trader for the same firm that Michael Marcus was, a firm called Commodities Corp. He had at that time he had almost 10 years of trading, and he had compiled a record of I believe it was like 88% average returns over that period. But again, I talked to him about his earlier days and what his failures were, and this was his worst trade. So back in his early days, Kovner was trading soybeans, and in soybeans you also have crop years, old and new. And he had this trade. He had this idea that there was going to be a shortage of soybeans, which was proved to be correct. And he had the second idea that one way, a lower risk way of doing this trade, was to buy the old crop because there was going to be a shortage, which was July, and as protection to sell the November, the new crop. And the idea was, if there was a shortage, that the July would gain on November, and that's also a valid idea, and that's exactly what happened. And he was doing tremendously well on that trade. And then one day there's a government report. The report's bullish, and the next morning the market is up limit in his July, and even the November contract is up limit. And he gets a call from his broker, and his broker says, Bruce, you're a fool. Why stay short? Why stay short to November? Just get out of the November, and then you'll have all long. And in a moment of weakness, he listened. He got out of his November. It wasn't more than 10 minutes later that everything turned around, and November went limit down, and the July even went limit down. And in any case, now instead of being protected, he had a net big open long position. He called it a moment of madness. So again, that was a horrible trade for him, the worst he ever did. So we have those three examples, and so here's the point, one of the points, and it has to do about failure, and that is that these three people I just gave you, as I gave you some of the history of Paul Tudor Jones and Bruce Kovner, who are more well known. Michael, I didn't tell you, but Michael, when he went on to join this firm Commodities Corp, they gave him $30,000, a $30,000 account, and in about 12 years he turned that into 80 million, literally from 30,000 to 80 million, and that was with them taking out 20% a year for expenses. So one of the most amazing trading feats ever. So these three people had mistakes which were enormous, probably worse than the worst mistakes that most of you listening have ever made, and yet they went on to tremendous success. So there are two important points to get here about failure, about this. Yes, they failed miserably, but number one, their early failure did not impede future success. So just because one fails totally in trading does not by any means mean that they're a failure or that they can't ultimately succeed. It doesn't mean, of course, that they will succeed, but failure by itself is certainly not an indication that future failure is likely or in the cards. And I've given you three examples of people who had miserable early failures and in some cases repeated ones, like in Michael Marcus's case, and yet went on to tremendous trading success. So early failure did not stop them from becoming super successful. And two is, one of the reasons they were successful is they just did not give up. And that speaks to other things such as confidence and hard work and other things that are very important to trading. But these 2 points together are critical, because it means that, because most people will fail. Very, very few traders, very, very, very few traders, even among those that I interviewed, very few were successful right off the bat and continue to be successful. In most cases, their earlier days were failures, and they learned from the failures, and that is what we go to next. There's a question about how you look at mistakes. Okay, so mistakes. One of the things I want you to take away from this talk is that mistakes are not necessarily bad. Of course, they're bad at the moment, and they mean in the markets you lose money that you shouldn't or needn't to have lost, but they can be turned into things that are positive. So first, before we go to the trading side of it, let me just give you I'll just read a few quotes about mistakes made by people who are very successful. Thomas Edison has a very successful quote, I have not failed, I just found 10,000 ways that don't work. That is the attitude of somebody who will succeed. Primo Levi, the chemist and writer, wrote, "More is learned from one's errors than one's successes." I assume Primo was not a trader, but no trader could write truer words than that. You will learn more from your mistakes than from your success. So when you do something wrong in trading, that is an opportunity to learn and to get better. When you do something right, yeah, you can pick something up from it, but believe me, there's much more that you can learn from your mistakes. And to take that into well, we'll go first to Ray Dalio, who is the Ray Dalio. For those who many should probably know who he is, but Ray Dalio is the founder and CEO of Bridgewater. Bridgewater is the world's largest hedge fund. They've also made in dollars more dollars for their investors than any other hedge fund in history, as far as I know. And then currently managing, I think, some ridiculously crazy number like 160 billion. So, you know, one of the all-time legends. And Ray Dalio says, if you don't mind being wrong on the way to being right, you will learn a lot. So let's go a little bit more to Dalio and this idea of how you learn from mistakes and how it can lead you to be a better trader. Dalio runs his firm on the whole philosophy that people are supposed to not only learn from their mistakes, but they're supposed to call out if colleagues make a mistake. They should be very upfront about it. There's no tolerance at all for any mistakes to be made and covered up. And in fact, mistakes are highlighted not to embarrass people, but to learn from the mistakes to improve the trading method. And the methodology that Bridgewater developed and the systems they developed, they grew and changed over time. And every time there were mistakes, the system and the methodology changed to incorporate what was learned from that mistake. Now, how as a trader does that translate to you? What can you do? I will give you some very specific advice, which really can be very helpful. So one thing I would say is keeping something like a trader's notebook or the trader's diary or log or whatever you want to call it. And the idea here is that you don't have to put every trade in. I mean, if you want to be really rigorous, you can note every trade and all that. But the most important thing to record is the trades where you learn something from, and those will, for the most part, be trades that were mistakes. So when you make a mistake, like you do something, and we all do it in trading. You do something in a moment that you should, let's say, very simple example, it could be anything. There's a million things people do wrong. But let's say you know you have a methodology that works over time, okay? But it doesn't give you trades every day. And you're watching the markets and you're bored. And you take a trade and you end up, and then so let's say some news comes out against the trade and you start losing money quickly, and it's a disaster, okay? Well, you know exactly what you did wrong. In that particular example, it's just one example. The example is not what's important. It's the idea that you deviate from what you know is right. So in this particular example, you know you were supposed to wait till you had a trade that met your methodology, your rules for getting into a trade, and you were bored and you just took a chance and you lost money. Well, there's an important lesson. The lesson is never, never, never take a trade that isn't part of your methodology. So that's one example. There could be a million examples. The idea is when you do something, and we all will make mistakes, but when you do something that's wrong, if you can record the trade and indicate what the mistake is and what you learn from it and what you now change in what you do. In the simple example I gave you, what you would change is never ever to do a trade that deviated from your methodology. That will improve your trading. But why writing it down? Because if you write it down, it reinforces it. And if you keep a diary of these things, you can go back every few months and read your own notes. And the next time you're tempted to do something that you know is wrong, it will be fresh in your mind. So, no, I'm not going to do that. I've got it as one of my rules. This is something I've written down. So that's a simple example of something everybody could do that they can learn from their mistakes and become better traders. And there's something else about it. If you've got it's what your mindset is. If you are willing to do this and recognize mistakes and learn from them, then it gives you respect for mistakes, and that means that you will know that you can be wrong, and you'll plan for being wrong. You'll have a better sense of your own vulnerability. So that's another benefit of kind of focusing on the mistakes. Because, and I speak from my personal experience, and I think many people will find this is true, but I know for myself, the absolute worst things I've ever done in the markets have always come after I've had good periods. And that's because we get complacent. But if you have a focus on mistakes, then you know that you're far from perfect and that you're vulnerable to making mistakes. And that can keep you from making mistakes in the first place. Okay, I'm going to add a couple examples here outside the realm of trading, but just about what happens if you don't recognize mistakes. I'm just going to give one quick one here, and we'll talk about the famous Challenger shuttle disaster, where the shuttle blew up, and this was sometime in the mid-'80s, I believe it was. And what happened was there were repeated delays in the launch of the shuttle, and finally the day that was supposed to be they were supposed to go, it was a day that was unusually cold, and the temperatures got down to freezing. Now the engineering of this of the shuttles and the fuel tanks is such that they had seals called O-rings, and the thing is that those rings had never been tested at temperatures below, at these type of temperatures. Now there was a lot of pressure to go ahead with the launch. Now the head engineer for Thiokol, which was the company that designed the rocket, he refused to sign off because he knew it had not been tested. But he was over, and his bosses were overridden because they yielded to pressure to avoid the failure in this case being a minor failure of another delay in the shuttle. But their inability to accept that hey, there's reasons for delaying the shuttle. I mean, this is weather, it's not even their fault. It's a minor failure, but their inability to accept that minor failure led to this disaster where the head engineer knew it was dangerous. Of course, there should no way that should have ever that launch should ever have been done. But that's what happens when you ignore. That's maybe the best example I can think of, a non-trading example of what happens if there's an environment where mistakes aren't and failure is not accepted. But it happens all around, and you'll find the best companies are those that are able to accept failure and learn from them. Okay, so now I'll go on to another subject here. There was an American program called 60 Minutes. Some of you may know it. It's basically a news, not quite news, but they do feature stories. And they did a story on a free climber called Alex Honnold, actually probably the world's best free climber. Now, I don't know if you may not know what a free climber is, but there are people who will climb completely, will climb these vertical ascents even without any ropes for protection. That's very few people do this. It's enormously dangerous. To me, it seems completely crazy. And you have a shot here of Honnold going up this vertical ascent without any ropes at all, and no protection. I mean, one mistake and he is dead, literally. So this is just a completely mind-boggling thing to do. Now, the reporter asked him, Alex, she said, do you get an adrenaline rush when you're doing this? And he looked at her with a shocked look on his face. And he said, no, I mean, there's no adrenaline rush. If I get a rush, that means something has gone horribly wrong. The whole thing should be pretty slow and controlled. Now, the exact same thing applies to trading. People have a misconception. They think that trading is about excitement. If you are trading for excitement, do yourself a favor and find something else to do, because you will lose. Trading is not about excitement. The best traders are you couldn't even tell. The really good traders, you can't even tell whether they're winning or losing that day. They're not getting this image of people around screens cheering and all the noise. This is a Hollywood image. This is not what real or successful traders do. Successful traders, just like Arnold going up a mountain, he's not looking for excitement. In fact, excitement means that something is desperately wrong. He's looking to be in control, to do it slow, to be thoughtful, to be unemotional. So emotions are not good for trading. You don't want excitement in trading. You want to actually avoid that to all degrees possible. One of the traders I interviewed, this kind of subject came up, and that trader is Larry Hite. Larry was the founder of Mint Management. Mint was the first big trend following or computerized systematic trading CTA. They ultimately sold the company, but this was the first really successful trend following CTA. In its day, the largest one. And Larry, when I spoke to him, told me about a story about a tennis partner he played with, and the one day, talking about trading, and he tells him how he's trading. He says, "Well, isn't it boring?" And Larry said, "I don't trade for excitement. I trade to win." So that's and in his case, everything was systematized. There was zero excitement. The computers did the signals, and there was and he had taken excitement out of it totally. And that is generally doesn't mean you have to be totally systematic. You can be discretionary. That's in fact many of the best traders are discretionary, but you don't want it to let excitement and emotions influence your trading. So how to control emotions? About a year or two ago, I was writing a blog. I'm not writing it now anymore, but I would invite, I had a column sort of called Ask Jack, and I would invite traders to send in their questions. And by the way, at the end of this broadcast, I'll open it up to questions for as long as people want to ask questions. But so you'll have a chance to ask your own questions. But I had this column, Ask Jack, and one of the questions I got was, do you think it's possible to use self-suggestion to have neutral emotions? I kind of gave an answer, but essentially more lengthy than on this slide. But my answer boiled down to, well, I'm not a psychologist, and this is not my expertise. And yes, getting control of your emotions is a good thing, and whether it's self-suggestion or some other method, that's not something I'm going to opine on. But I will tell you, there's a much easier solution. Is that if you want to get emotions out of trading, it's really simple. There's only 3 rules. Okay, so the solution is, first of all, rule number 1 is you need to have a trade entry plan. You need to have a specific set of rules that define when you get into a trade. Now, there may not be just one set of, you may have multiple types of trades, but each type of trade would have its rules. Okay, when this and this and this happens, this is when I take a trade. Okay, so or it could even, it doesn't have to be absolutely rigorously specific. If you're, let's say, a chart trader, you could, and chart patterns are variable, but you could still say, when I get a chart pattern and I interpret it as such, I will do this, and then I will, you would still have a plan on how to get in. Okay, so number 1 to get emotions out of trading is have a trade entry plan. Number 2, you need to have a trade exit plan. So, in fact, that's maybe even more critical, because a lot of people stop at the entry. A lot of people, they put 90% of their energy into figuring out when and how, or maybe sometimes 100% of their energy figuring out how to get into trades. Everybody focuses on how to get into trades. But really the secret is that getting out of trades is as if not more important. And so you need to not only have a way of getting into trades, but you need to have a specific plan of how you will get out of a trade. And you need to have that defined ahead of time. So that's the second part. And the third part the third part is there are prohibited trades. And what are prohibited trades? Any trade that isn't part of number one or number two. So it's very, very simple. You only take entry, you only enter trades which fit the plan. You have a plan to how to exit trades, and anything that doesn't fit into that, you just don't do. And that's really all that's necessary to get emotions out of trading. So now let's go to the question, the item of risk control. Now I know you've heard this, you've heard about risk control and all that, but I'm going to spend some considerable time here because it is actually far more important to your success as a trader than any methodology itself. Great traders aren't great traders necessarily because they have a terrific way of getting into trades. The one thing they all have in common is they have methods of controlling their risk. If you don't have that, then one bad trade can take you out of the game. And if you think back to the examples I gave you with Marcus and with Jones and with Kovner, those early failures, well, what were they failures in? They were failures of risk control. Marcus taking all of his money and borrowing money from his mother and putting it all into one trade. I mean, failure of risk control. You know, Kovner, who had this trade well balanced and protected, lifting one leg, leaving himself totally exposed after the market had gone a long way in his direction. Again, a tremendous failure of risk control. Jones putting on this position, which was way too large. Again, failure of risk control. So even great traders, well, this was in their earlier days, can have these failures of risk control. But risk control is essential. And without it, you can easily get knocked out of trading altogether. So let's talk about some specific ways of looking at it and achieving it. Now, Marty Schwartz, who was a very successful trader at the time I interviewed him, he had just an incredible record, a record which was really impossible to continue. He had literally 10 years. He had it audited. He had 10 years where he had only 2 losing months. He was averaging like this extraordinary number of 25% a month. The only way he was able to do that, by the way, was because he was constantly taking money out of the market and keeping his trading to a relatively small size. Otherwise, compounding would have made it much too large to get those type of returns. But still, it was an extraordinary record that he compiled. Marty spoke about this, and he says you have to know your uncle point. Now, that's actually probably an American expression, and I don't even know if it's still used much. It was an expression when I was a kid that we used. But an uncle point is like if 2 kids are fighting and one sort of bends the other arm till he gives up, and they would say, yell uncle. Why uncle? I can't tell you, but this was kind of yelling uncle means you're sort of giving up. So what Schwartz is saying, you need to know your uncle point. You need to know when you're going to get you yell uncle to the market when you give up. You need to know that. Kovner put the same idea in a very specific form, and I'm going to give you Kovner's quote here exactly. And interestingly enough, this quote I'm going to give you in this piece of advice, it's actually 10 words long, and I often tell audiences when I give talks that if somebody said, Jack, you can give trading advice, but there's one restriction here. You can only use 10 words. So if I had to, let's say, do this webinar and use 10 words to give advice, these would be the 10 words I would use. Know where you get out before you get in. I'll repeat that. Know where you're getting out before you get in. And now, why is that so critical? So it's critical because before you get into a trade, that is the only time that you have complete objectivity. Once you're in the trade, you lose that objectivity. You're no longer thinking completely rationally and straight because you're now committed to the trade. You're making or losing money. Your thoughts change. So before you get into the trade, you can think very clear, very rational. You can do your best planning. So the idea is You choose where okay, you decide I'm going to do this trade, fine, you're going to get in trade. Okay, assume you get into the trade. Now, where do you get out? You decide that before you get into the trade. And you stick to it, of course. Now, if you do that, it goes back to the other point we were talking about. You take emotion out of it because you no longer have to agonize of where do I get out of the trade. You've already decided. And in fact, many times you can just do this with a stop. So you say, I'm going to buy this stock at $50, and if it goes down to 45, I'm going to be out, or whatever. It could be any market. And you put in a stop to get out, sell at 45. Making that decision ahead of time takes the emotion out of it. It also does something else that's very important. It guarantees that you limit your loss to a predefined amount. So part of risk control is, in fact, keeping your risks to a fairly small amount on each trade. Let me go back on this because I thought I had a slide, but I'm not, so I'll just say it at this point. For example, Larry Hyde, who I spoke about, he had a rule that you never ever risk more than 1% of your money on any trade. And the only criticism I would have of that rule is, if anything, 1% is too much. So, but the idea that you don't risk more than a certain amount on any single trade is another also important way of controlling risk. So you can have multiple mistakes and still be in the game. So now on the subject of stops, a lot of people approach entering stops the wrong way. Now, one of the managers I interviewed was a London hedge fund manager by the name of Colin O'Shea, runs a hedge fund called Comac. He talked about how traders, many traders just have the wrong way of selecting stops. And he said, what a lot of traders will do is they'll say, okay, I want to put on this trade. I trade. This is my trading size. I normally buy two contracts or whatever it is. It'll say futures, and they decide on the. They know what the trade is they're getting into. They know what their size is, and they figure out, okay, I'm willing to lose X dollars, and so that will determine what their stop is going to be, because they know what their trade is, and they know what their trading size is, and therefore they can then bring them to their to do what their stop should be. And O'Shea's point was that that's completely misguided. What you want to do is not determine your stop from what you're willing to lose and what your trading size is. Exactly the reverse situation. What you want to do is you want to ask yourself the following question: where should the market not go if I am right? Where would the market, what price would the market go to that would prove I'm wrong? You need to answer that question. So if you're going in at 100 and you feel the market should not go back to 99 or whatever it might be, and if it goes to 99, if let's say the chart pattern you went in on would represent a failure, then okay, then 99 is where your exit point is. The market should not go down to 99. Then you would say, well, that's a 1-point loss. How much is 1 point per contract or per share or whatever it might be? And that would determine your trading size. So the important lesson here is that you determine the exit point first. It's not something that comes out of how much money you're willing to lose and what your trading size is. You determine where the market should not go, what would prove that you're wrong. That is what you decide first. And once you've decided that, then you know how much money you're willing to lose, then you decide what position size you could take. There's a dilemma that most traders, if not all traders, face, and then a lot of times, is you're in a losing position, and you, on one hand, think, let's say it's a long position. Could be short, doesn't make a difference, but let's say you're long, and the market's going down, and you're losing more than you want, and you're worried about the position. But on the other hand, you think boy, if I get out now, I'll be getting out right at the bottom. And so you have this dilemma. You just don't know what to do, and you're like frozen like a deer in the headlights. Now, one thing that came out of my interview with Steve Cohen, and I know Cohen has had a lot of controversy regarding insider trading or whatever, and while his firm got convicted, people at his firm got convicted, he never did. But I'm not going to go into that. I don't have an opinion. I don't know more than the investigators do. But I can say this with confidence that regardless of that, he may, he has his track record is so enormous that it's inconceivable. But if he would have, if insider trading would have been a big part of his performance, then they would have definitely found evidence. So I'm not saying that I have no opinion on whether he had any inside trades or not, but I do feel strongly that he was an incredible trader. So that's separate of any other issue. Now, one of the things he said was when asked about this question of how to handle that situation, he said if he's ever in that situation where he doesn't know what to do, he just cuts his position in half. And if he's still in that position a little while later and he's still in the same, doesn't know what to do, he cuts it in half again. And he said sooner or later, you cut it in half, it's not a problem anymore. So we, as our human nature is such that we always want to be 100% right, and because of that, we often end up being 100% wrong. So this is not just a matter about this dilemma. If you're in a position, don't know what to do, it applies all through trading. You don't have to take actions that are always 100%. So if you're uncertain and you're worried, like in this case example I gave you, well, begin by getting out of half the position. Now, what happens to get a half the position? If the market rallies back, yeah, you'll say, I should have kept it all. So you're going to be unhappy. And if it continues to go down, you say, I should have gotten out of all of it, so you're going to be unhappy. But the point is that in either case, you're still better off if you're wrong, because if it goes up, if it does recover, you still have half the position, and if it goes down, you don't have whole position. So a lot of times decisions which are halfway decisions when you don't know are a better path, and that's true if you have a position and you let's say you're making, because a lot of cases, another example might be you're making money on a position, you made a lot of money, you want to let it go, but on the other hand, you worry about giving it back. You can get out of it, you can take profits on part of it. And if it keeps on going, fine, you'll still have the rest of it. So this comes in all through trading. Keep in mind, you don't have to treat every position 100%. You can get out some part of it. You don't have to either get in totally or get out totally at one time. That's an important lesson by itself. So next well, I actually gave this risk management doesn't have to be complicated. I told you what this is where we covered it. The idea of like something as simple like a 1% loss or something smaller than that, maximum on any trade. Now I'll give you another example here from Bluecrest, which is a London hedge fund. I interviewed Michael Platt. Now, when I had interviewed them, they had a track record of a dozen years or so. But the thing was, the track record was that returns. It wasn't that the return was high. The return was like an average of 14% a year. That's good, but it doesn't sound great. But the thing was, they had never had a drawdown more than 5%. So this is what was very impressive. So how did they get that type of return with never having a maximum decline from a peak to a low, which was more than 5%. So that really came out of that money management system that Platt had imposed. So this was their primary fund, which he managed a portion of it, and he also had portions of it were managed by other managers, and they all lived by the same rule. At the beginning of the year, they would they would have their allocation, and they were allowed to lose 3%. That's not very much. They were allowed to lose 3%. If they lost 3% from that starting point, again, the starting point, not a 3% decline at any point, but from the starting point, if they lost 3%, then their allocation was cut in half. And if then from that point on, if they lost another 3%, their total allocation was gone for the year. Now, what that did was something very important. It meant that no trader could lose much more than about a little over 5% because 3% twice compounded losses are just over 5%. So that meant that no trader could have a large loss to the portfolio. So again, it's a very, very simple rule. Down 3%, cut your half the allocation. Down another 3%, you stop trading. You could actually do something like that with your own trading too. Now, it may sound like, well, how could you ever make money? Well, here's the trick. The trick is the 3% only applies to your starting level. So in the beginning, what traders would do is they would be more cautious. They build some cushion, then they would start taking more risk. So if a trader got ahead of the game, if they were up 10%, they had 13% risk from that point. So the more ahead they got, the more potential risks they could take. The idea, though, is by setting it well-controlled, relatively low amount of money to lose from the starting point, it's sort of guaranteed that you could not have a large loss. And that's an idea that any trader can do. You could do that. You start trading, or from your account, you say, I'm not going to risk more than this. If I do, I'm going to cut my risk. And if I lose this much, I'll stop trading. And stop trading, and that doesn't mean you stop forever. It means you give it some period of time until you begin again with fresh. This is like something, and this is exactly the point I'm talking about, and this is something that I've always done. Is when you start trading, and my own case, I don't trade all the time. Whether I trade or not depends on a lot of things. It depends on how busy I am. It depends whether I feel like trading. But for me, I've been a writer about traders. I've been an analyst. Those things I've done all through my career. But trading has been sort of kind of more of a hobby. It's not been my job, so to speak. But in my own experience, and this is something I learned early on, is whenever I start trading, I kind of have I start for a relatively small amount, and certainly a small amount that I'm willing to lose. And if it goes, fine. If it doesn't go, then I've lost a small amount. I'll come back another time and try. But that way, I never lose much from whatever my starting stake is. And most often, because I start small, I can get ahead at some, and that's not an issue. So that is a great way of making sure you don't lose a lot of money, and that of course once you get ahead, then it can make sense to move that point up. So if you're ahead, you want to then not go all the way back down below zero. You may want to then change that exit point, so you or take money out of the market to make sure that you've locked in some profits. Okay, so there's also another connected reason here of avoiding large losses. The obvious reason, large losses are going to are painful, and they're going to hurt your ability to recover and all of that. But the other people forget that it also will impact. It may mean that you miss trades that would have been very profitable. And Michael Platt, who I talked about, uses an analogy, and he doesn't mean it literally here. He's not advocating hunting elephants. He's just using it as an analogy because an elephant's a large animal. He says it's like you're hunting and you're loading your gun when the elephant walks by. And he said when you're losing it, when you do something stupid in the market, by taking a larger loss than you should have, you're so emotionally destabilized that when a really good trade that you normally would have taken and was obvious comes by, you're so upset about the losing trade that you miss it. So that's what the analogy means. I'll give you another thought here, that you don't have to always use stops for markets which have liquid options. You can use stops as a way to protect yourself, and they do have certain advantages. So I've just made up a simple example here. Say you wanted to buy some stock at $24 and you were willing to risk a $2 loss on it. So you could do the simple thing, which is buy it and put a stop in at 22. Now that's fine. That'll control your risk to $2 on the trade approximately, given any slippage. But the problem with that is, what if it goes down, let's say, to 21 and then comes roaring back? You're going to be out of the position. Well, there's an alternative way of kind of achieving a similar thing, and that is instead of putting in a stop, you can buy a call, which is in the money. So you buy a call, let's say a $22 call. So that call is, is $2, has $2 of value in it because the market's at 24. And of course, you'll have to pay a premium, a time premium. So let's say the price of the option is $3. Now, if the market, if you're right, the stock goes up to 30, in the first case, you would have made $8. If you bought the call at 22, you make, I'm sorry, if the market goes up to 30, you would make $6 because the market was at 24. If you bought the call, you'd make $8. The call would be worth 8, but you would pay 3, so you only make 5. So you'll make less money. You will make less money. But the advantage of it is, let's say in my example, the market goes down to 21 and then bounces back. With the option, you're still in the trade. So that's an alternative way of achieving the same end as a stop in a way that lets you stay in the market. At some cost, but the cost comes primarily if you're right. Okay, so a couple of more, just a few last points before we open it to questions. So one thing you need to keep in mind when you're trading and risk control is that the markets are not a static thing. They're very changeable, like the weather. I mean, you can have a nice clear day, like the picture on the left, and you can have a tornado or a hurricane. The weather changes, and you would not trade, you would not go outside for an activity in the same way when you have a situation on the left versus a situation on the right. You adjust your behavior because the weather changes. Well, you need to adjust your trading similarly when markets change. So, for example, in 2008, the markets became enormously more volatile. If for those traders who were still trading the same way in 2008 as they were previously, what would have been conservative and rational and prudent approaches would have been wildly speculative because the markets had become so much more volatile. So, for example, O'Shea, who I talked about, he gave this example of how he would talk to other hedge fund managers in 2008, and they would say, "Yeah, these markets are crazy. I've cut my risk in half," and he would think to himself, "Half?" Like they thought they were doing they were being good because they were cutting their risk. He said the volatility is going up by 5, so cutting in half still leaves you tremendously overexposed. So you need to be very cognizant of the environment of the market. And you need to be cognizant of correlated risk. So if you're long the euro, you're long the Swiss, it's not. You have in some ways, similar trades, and it's not like you have two independent trades. So like this bus, the people on the bus, it's not like the risk of a rider on this bus being injured because of it going off this rickety bridge. It's not independent. If one rider gets hurt, likely they'll all get hurt because that means the bus went over the side, or none of them get hurt. The point is that they're not independent, and market positions are like riders on this bus. They're not independent. Now, some market positions are, but if you have positions, or particularly in the stock market, if you've got multiple different stock positions, they're not like all separate positions. They're likely to go down together. So you need to have a sense of the degree of correlation between your positions to know what your overall risk is in your entire portfolio. And I'll have one last point here before we go to the questions, and that is about what traders and investors overlook in volatility. So I've got a picture of two managers. One, they both go up over time. The black manager ends up with a higher return. The white manager, lower return, but a much smoother performance. Now, some traders would say, well, I'm only concerned about how much I end up with, so I'd rather have the black. I'm okay with an approach that has more volatility as long as I make more money. And some investors, if it's an investor, they'll look at these two managers and say, well, yeah, I understand that there's less risk with manager white, but manager black, he'll make more money, and I don't mind. I can take the risk. I'm a strong person. Well, the truth of the matter is, what they overlook is that in real trading, you don't know how it's going to end up. So if you know this is how it ends up, and you're going to make a decision of which, if these are systems, which one do you use, or these are traders and managers who you're going to invest in, who do you invest in? Well, if you know how it's going to turn out, yeah, you take black because you end up with more money. But in the real world, you don't know how it's going to turn out. And if you think about each of those times black is having a big drawdown, you don't know if it's going to continue going down or will recover. And the truth is, many traders, if it's trading, or most investors, if it's investing, will abandon the investment or the trade if you get one of those big drawdowns. So the reality is, if there's lots of volatility, you'll never be around to see the recovery. So that's another very important reason to try to avoid excess volatility and risk. So okay, so that basically kind of wraps up the points I wanted to address this morning. And so we'll open it up here to questions.
Thank you, Jack. Excellent presentation and excellent introduction to our topic that also we'll be covering. It's very important. I know that risk management is everything. I mean, that is the holy grail in forex trading and generally trading, and that's the real truth. Exactly, you share my thoughts too. So excellent presentation.
Thank you.
Also, can we have a great question from Gary Coroneos? If you can maybe answer, because you're the analyst, what is your medium-term view on the price direction of the U.S. equities? And he said, considering, if you can see the question, considering the SP 500 Shiller price-earnings ratio is 30 and so on. Okay, so what do you think about it?
Okay, so I got a couple things to say here. So first of all, one of the things that people who know me know, and one of the things, one advice I tell people is you don't want to ask anybody their opinion, and that certainly includes me. But I mean, even the best, and I sometimes in talks I talk about this and my own experience wherever I was weak on this, and I listen to somebody who was a much better trader than I am, and it always doesn't work out. So I just think in general, I just think it's bad to go to I don't care who it is. I think it's just a bad idea to look to other people for opinion, because you need to have your own methodology, your own approach, and if you get influenced by other people, it's going to mess it up. So just actually, I think that's more important than an answer to the question of where the market will probably go or not, which is, my opinion, would just be an opinion. Now, but I will address the other element of it, that which is implicit in the question, which is that the market is high priced. And certainly Shiller's methodology of measuring the market's overpriced is certainly quite sound, as good as anything else. And Shiller himself has a good record of identifying markets which are kind of overdone. And so so all of that may be valid. The thing though is, this is the cautionary tale. Markets it's easy to identify when a market is overpriced or in a bubble phase. The trouble is, there's no way to identify how extreme it can go. Now let me take a bubble that already is behind us, as opposed to one that we may or may not be in. But say take the 2000, the internet stocks and that particular tech bubble that culminated in March of 2000. Now the Nasdaq went up to, I think it was something like 5,400. I forget the exact number. It went up sixfold, 600%. And what was happening is stocks which were losing money, that stocks which never made money, and were actually had a burn rate, which would mean they would just not last more than a certain number of months, were going up too, sometimes going up tremendously. And some of the worst stocks were going up the most. Now, it was easy to say in those particular times, well, in 99, 98, or certainly in 99, it would have been easy to say these stocks should be worthless, and they've gone up. The stock has gone up 5 times, but the trouble is it could go up 10 times, it could go up 20 times. There's no idea of knowing how far overdone is. It doesn't mean that one should look for ways to take advantage, but it's very hard to identify. Usually the market has to have some sign of failure before that's possible. Or I mean, one can try. I mean, you could try to pick. You can do target objectives. Let's say, well, if it's a bubble, there's no resistance areas defined above, but you can do technical swing measured move objectives or things of that, or of certain things, and say, well, the market should fail around here. Or you can look for bullish news to come out and markets to behave in a way where it fails to respond positively. You can look for signs like that, and you can try probing for the short side. But if one does, you always have to have a stop in, because there's no way of identifying how far it is up. Now, that the NASDAQ example, it went from 1,000 to 5,400 or something like that. Well, the top could have been 3,000. It could have been 10,000. And my belief is that there actually is no definitive way to determine what it would be, because I think markets are so complex that if you had all the same events occur, one time you might go to 5,000, one time you might go to 7, one time you might go to 3. It's not always going to play out the same way, because when you get into that, small differences can make a huge difference in the ultimate. It's sort of like the butterfly effect in chaos theory. So that's a long answer without even answering the direct question. But my 2 points is, don't look to other people for advice. It's for most people it will lead you wrong, no matter how expert the other people might be. And secondly, yes, I'm not advising against trying to maybe take advantage or try to profit from markets that are overdone. But if you do so, keep in mind that markets, there's no way of defining how far overdone is. Markets get far more extreme. In lots of cases of markets going way more extreme than anybody could have imagined. And if you try that, you need to have some way of picking the spot. And most importantly, you need to have a way of limiting the risk on that trade.
Yeah, great explanation. And just Gary added, I can ask, are penny stocks with no earnings showing signs of a bubble in the U.S.?
Well, I mean, basically, the market is high price, so by that virtue. But again, bubbles are hard to define, because once you get into overpriced, how far overpriced? The markets those things play out radically different in different times. So it's very hard to say at what point is it sort of in a late stage of a bubble.
Thank you.
I mean, of course, I mean, like just say, see, there's things we can all see. There's the debt problem. It's easy. It's like the market ignores things. It ignores it until all of a sudden it starts paying attention to it, and then things go. So all the things in that NASDAQ example I used, the tech bubble, all the things that caused the destruction, and by the way, that market went all the way back to where it started from. So it went up 6-fold, and then it went down the same amount, and each in a year and a half, by the way. And all the things that led to its demise were known ahead of time, but just you never know where it was going to stop. So that's the difficulty. But just because something is overpriced, again, the hard thing is you just don't know how far it's going to go. Even you may know the reasons, and you can be 100% right, where you can define all the reasons for the next bear market. The market's overpriced. There's a lot of particular problems. There's, like I said, the debt issue. There's the problem of trade, anti-trade sentiment, maybe actions. All those things are negative, but when does it start to bite? That's a tricky question.
Yeah, I got it. Yeah, you're right completely about it. And Gary, I hope that you're happy with the answer because definitely, yeah, everything has its own agenda, and markets are always going up and down, trying to get a price into the equilibrium. So do the technical analysis and try to find a spot to sell well and protect your trade as always.
That's
Now the
exactly.
question. Yeah, I've been doing that for a long time, protecting my trades, using profit stops always. So because the market is very volatile. Now the question, which one indicator do you recommend to use in 1 minute, 15 minutes? And what about indicator setting?
Okay, so that's again. I've interviewed traders who traded, you know, a long-term trade might be, you know, several hours, and I've interviewed traders who a short-term trade could be 1 year. So that really varies all over, and that's really that's a matter of methodology. One of the things I always stress that I didn't in today's talk, but one of the other points I make very frequently is it's very critical for everyone to develop their own specific methodology that fits their personality and so forth. So there is no particular right. Now, longer term charts, like not intraday anything, but daily or weekly charts have more information, are more reliable because the time scale is long. Of course, it also means that meaningful risk points are much wider too. Uh, and so in that sense, and my own biases, my own preferences is to use daily charts. I'm not a big fan of intraday charts, but there are people who are quite successful in intraday charts. So it really comes down to your methodology, and that there's no magic about one type of chart being right and another. It really depends on what your methodology is and where it works. So for some people may find methodologies that work on 10-minute bar charts, and other people will just get whipsawed to death. So it really depends on what your approach is. There is no right answer there. There's no right or wrong answer there.
Yeah, that's it. Yeah, some people prefer long-time trading, long-term. Some people prefer intraday. Yeah, I'm a bit of intraday trader, been a bit successful, but it all boils down to psychology, definitely. Because if we make one or two good trades, we can easily kill that with a 1 minute trade that goes wrong if we use the old leverage. So it all boils down to risk management. Yeah, good question. What is the best way to track where a big money goes? A volume indicator is not showing the full picture. This is the good question, and I think it's referred to smart money, but in Forex market, you cannot use the volume indicator because it's only a tick volume and futures volume. It's not like stock market, it's decentralized market completely. So yeah, you can also answer your opinion. I'm also interested in that.
Well, volume, I think in stocks you can. Yeah, I think it's probably most potentially useful in stocks where you can see sudden increases in volume, which may be indicative. Uh, it's like it's another thing to consider. Or let's say if a stock's in a long basing area, and you suddenly see a spike in volume, it might indicate that something is happening or about to happen, so it could act as an alert to look at it more carefully. Uh, there are certainly ways of incorporating volume and price together as indicators. It's not something. I mean, actually, I at one time, a long time ago, I did put together an indicator like that, but I ended up not using it a long term. But if one does that, if one puts together price and volume, my suggestion is the typical way it's done, I don't particularly like, which is if a day is up, then all the volume of the day goes to the upside, and if a day is down, all the volume goes on the downside. I've suggested if that's the type of thing you want to experiment with, then I would prorate it. In other words, you don't want to count a day that is up 100 points the same as volume of a day that's up 1 point. So I would weight it by so if I'm using volume, included with price to weight price in some way. If the volume is if you're creating a volume chart like that, you would want to consider the amount of up movement or down movement, not just whether it's up or down. But generally speaking, it's something that some people use if If you find a method where it can be useful, fine, but it's actually not a methodology that I've employed.
Exactly. Thanks. Okay, and yeah, I'm not sure how much time we have. What is basically how much time do we have for questions? We can maybe answer one or two more questions.
Yeah, I'm here as long as you'd want to. I won't restrict you, so you can make the call to any questions. Especially since I was late.
Yeah, no worries. Yeah, it's a the difference of time zones. Yeah, I know, we know that. So no problems. Yeah, the good question also. But I think that you already replied, but we can cover it. Is it better to trade with different assets or to concentrate on one or two assets? So basically, it's a question: should you trade different markets or not?
Okay. So the question, but is it better to trade many markets or one market? Generally speaking, I would say many markets, because one of the things we didn't talk about, but which is important, is diversification. And if you're trading one market, you can't diversify. So and then diversification is not only a matter of risk management, but it's also opportunity. So if you're trading one market, there may just not be any opportunities in that market, period. Lots of markets can go into periods where they just chop around and there's no opportunity. If you're trading multiple markets, then you can focus. You can go from market to market and just go with the markets that seem to have an opportunity for whatever your approach is. So certainly, as a general response, I would say I would always go to multiple markets as opposed to one market. But having said that, if you are the rare individual that comes up with a methodology that is very effective for a single market, then that's fine. So Marty Schwartz, who I spoke about, he actually just traded S&P when he was in his prime, and that worked phenomenally for him. So it really comes down to your methodology. If you've got a methodology that works on one market, then more power to you. That's fine. But as a general philosophy, if you're making a choice, should I trade one? Should I trade multiple? I would say multiple markets is the right answer most of the time.
Yeah, I completely agree with you, and I always say I would just jump in with a comment. So if you want to trade multiple markets, I advise generally trading equities and yen pairs, because yen is very, very correlated with risk sentiment and with equities. So ASX during Asia session, SP 500 during US session, watch the direction, trade the Australian dollar yen, the GBP yen, and the dollar yen. Those yen pairs follow equities the best in terms of correlation. And my explanation is because the Japanese can get cheap credit, they want to invest overseas heavily. So when it's risky, they repatriate the money back, creating demand for yen. And vice versa, when it's bullish equities, they want to pump their money overseas, which means they sell yen and buy foreign currency. Okay, so try to watch it. It's very important. And yeah, I hope, Jack, that you agree with me. I mean,
that ties into what I was talking about correlation before.
Indeed, yeah.
And I would add one thing, though. Those type of patterns, like the one you said, some types of correlation are always there, like correlation between stocks in the same country market. That's that type of correlation doesn't go away. But certain types of correlation, like between stocks and bonds, or between yen and stock equities, those type of correlations, there will be phases where they can exist and then they can fade away. So you need to be current.
Yeah, indeed, and that is why we watch risk on and risk off sentiment.
Yeah, the correlation matrix is a good thing to look at. Yeah.
Yeah, that's a great thing. So yeah,
of course, it's a great link to our MT4 Supreme. So for all the Forex, what we offer to trade, we have a correlation manager. If you want to see more about correlations, just use MT4, MT5 Supreme, like you can see now with my screen, and you will get lots of trading ideas every day. Yeah, I'm still also here. This is still Jens from Germany. Thanks a lot. I guess one last question is possible, and then the limit is our time. Thank you, and don't forget to join the next webinar. I guess Nenad will introduce and invite you again, because we will have too much more. And if you don't get enough from our webinars, check out atlanmarkets.com and just register to all the other trading webinars. Many, many things just for you. So, and don't forget, that's what I want to show you, correlation matrix correlation trader directly in MetaTrader.
Excellent, Jens. And yes, there was a question, is there a correlation between the SP 500 and X30? So just bring on the correlation matrix and you will see a lot more than just SP 500 and X30. You will see it on every possible time frame shown. So just go with the correlation matrix. And finally, Jack, the question, I think that you're the expert for is definitely, I am 101% sure, how to deal with emotions. The question, how to deal with emotions, I can predict market moves, but if I'm not using money, when I use money, I fail.
Okay, so I answered this question in my talk. So my advice is to the person who's saying I can't predict you know, market moves, but when I use money, I fail. That's very common because emotions mess up trading. So that makes all the sense in the world. So my advice is what I said before: follow the 3 rules. One, you can pick markets. Okay, decide where you're getting in. Also, before you put the trade on, decide where you're getting out. Okay, now you have an entry order and a good till canceled stop order, which goes with once that trade is entered. And then the 3rd rule is don't do anything else. So that's it. So that's how to get emotions out of trading. Just you decide what you want to do, decide where the entry should be, decide where you should get out. In both cases, both where to get out, if it works, and where it doesn't work. You know, most importantly, if it doesn't work, but also if it works, what's the plan to getting out? You know, and that could be a trailing stop, it could be a lot of different ways, but you decide that at a time. So for this particular listener, if you're good at calling markets and you're getting messed up with real money, just make your decisions of entry and exit plans ahead of time before the trade. When the trade is entered, you enter your stop, and then if you're using a trailing stop, then just periodically raise that stop, and don't do anything else. And that's it. And then there should be no emotion because you've already decided by putting in your stop, you know what the maximum amount you could lose, and that is an amount you've already decided you can live with. So there's nothing to be emotional about. There's no decisions to be made. You've made all the decisions before you entered the trade.
Yeah, I completely agree with you. And I remember you mentioned 14% of return of investment per year with only 5% drawdown. That was a great result because my 2.5 year statement was showing 21% in 2.5 years and 9% to drawdown. I still have the statement. So everything boils down to money management. Lower your risk, drop your risk. Don't trade with big risk, and you should be better. Definitely.
And make the decisions ahead of the trade. That's also very important.
Exactly, because a risk should be pre-planned. It should be in your trading plan. So make a trading plan.
Exactly.
Jack, it was really a pleasure talking with you. I would continue really, but we are restricted with time. So
sure.
Thanks a lot. I hope that we will see and hear from you soon. Again, I hope that you also enjoyed. So, guys, that was Mr. Jack Schwager, a very famous market wizard, and I hope that you learned a lot from this webinar, and I hope that we will see him again. So, whatever is unclear, please do not hesitate to contact us, and your questions will be answered. Thanks again, Jack, and nice meeting you. Talk to you soon.
Very welcome. Thank you very much. Bye-bye.
Cheers.
So
have a
don't
great
forget
day
to join the next one with Steve Neeson. It will be on 28th of September. You are automatically registered when you're joining this live webinar. So see you soon again on 28th of September.